Today is January 7th, 2026, and a familiar question echoes in households across the country. Is it smarter to rent or to buy a home this year? The answer is not a simple yes or no. It is a complex calculation that depends on your finances, your location, how long you plan to stay put. To make a clear decision, we need to move past guesswork and look at the real data shaping the market. The housing landscape has shifted dramatically since the frenzied years of the pandemic. Understanding these changes is the first step toward finding your answer. The decision you make will impact your financial well-being for years to come. 2026 offers a mixed but cautiously optimistic picture. After a period of higher rates, mortgage experts are forecasting a slight easing. Realtor.com and Redfin project 30-year fixed rates around 6.0 to 6.3%. That is a dip from last year's 6.6%, but still above the historic lows earlier in the decade. When you decide to buy a home, the purchase price is only the beginning of the story. Total ownership cost includes many upfront and ongoing expenses that renters do not shoulder. The first hurdle is the down payment. 20% avoids PMI, but many buyers put down less. Then come closing costs, typically 3 to 4%. On a $400,000 home, that is $12,000 to $16,000. You pay for loan origination, appraisals, and title insurance. Once you have the keys, monthly expenses begin, beyond the mortgage. Your principal and interest are just one piece. Principal, interest, taxes, insurance, maintenance. Visual. The monthly pie includes all of the above. Property taxes vary by location. Insurance protects your investment. Taxes and insurance are often escrowed. Many homes add HOA fees, which cover upkeep but raise costs. Repairs can be unpredictable, and they are on you as an owner. Budget about 1% of home value per year for maintenance. Renting offers simplicity and predictability, at least in the short term. Your primary cost is the fixed monthly rent in your lease. Upfront costs are lower, a refundable security deposit and first month's rent. No closing costs, no down payment, no appraisal fees. Renting stays accessible if you value liquidity. But you are not building equity. Paying $2,000 per month for 30 years totals $720,000 with no ownership asset. You avoid repairs and property taxes, but miss appreciation and mortgage paydown. Fixed rent is fixed only during the lease. Renewals can rise. Nationwide rents are expected to rise about 2 to 3% in 2026. Fixed-rate owners enjoy stable principal and interest. Renting gives mobility, move at lease end, without selling a house. It also shields you from price declines. Owners bear that risk. In high-cost markets or for mobile lifestyles, renting by choice is a legitimate strategy. Do not decide on national averages alone. Out of 343 U.S. cities, only 32 were cheaper to buy than rent. Those markets were largely in the South and the Rust Belt. Coastal markets like California and Greater Seattle can be 3 to 4 times costlier to own. In Boston, required income for a starter home jumped from $98,000 to over $162,000. In parts of the South and West, new apartments and vacancies are pushing rents down with concessions. Do local homework. Compare median home prices, median rents, taxes, insurance, and maintenance. Visual cumulative rent and buying costs often intersect around year 6. Assume rent is $2,000 per month. Assume a $400,000 home with 10% down. That is $40,000 down plus about $14,000 in closing. $54,000 up front. A $360,000 mortgage at 6.3% is roughly $2,235 principal and interest. Add taxes, insurance, and maintenance. Total can approach $3,000 per month, about $1,000 more than rent. But year 1 includes about $3,500 in principal paydown and roughly $4,000 from 1% appreciation. About $7,500 added to net worth the first year. Over 5 to 7 years, equity and appreciation typically overcome upfront costs. After rates, prices, and regions, the rule of thumb is simple. If you expect to stay fewer than 5 years, renting is almost always the smarter, safer, cheaper choice. Buying's upfront costs are hard to recover quickly. Renting preserves flexibility for a new job, family, or preference shifts. It also buffers short-term market dips. If you will stay at least 5 to 7 years, buying becomes powerful. You can ride out cycles, build equity, and customize your home. First, confirm savings for down payment and closing without draining your emergency fund. Next, verify your budget can handle mortgage, taxes, insurance, and maintenance. Consider whether you prefer hands-off renting or the autonomy of ownership. Use local data and calculators to compare apples to apples in your neighborhood. By focusing on your personal bottom line, not headlines, you can make a confident decision that serves you for years.